Welcome to this webinar, Easy Equities community. It is always great to be with you. And for those of you that I haven't had the pleasure of engaging with before, my name is Carl Nalter, and I'm part of the Easy Equities team. And it's my great privilege to host this webinar. I'm joined by Nerina Visser, who, I don't think Nerina needs much introduction for those of us, which is all of us on this call that follow the markets. Nerina is fearless and fabulous. She's an ETF strategist. She's a market commentator. And Nerina is the financial brain, or the kind of financial brain that you want on speed dial when the markets are doing all kinds of things that we don't understand. And luckily, we do have her on speed dial because as a director at ETFSA, she doesn't just ride the trends. She helps define them. And alongside her team, she's always happy to engage with the Easy Equities community. Nerina, as I said, is super smart. She's a former president of CFA South Africa, and she's all about educating and demystifying the markets. So with her usual and fabulous straight talking, sharp insights, and I'm hoping a few ETF and other picks, Nerina is going to do a short little presentation, and then I'm going to ask her some questions. Nerina is always happy to take questions from the community. And I'm particularly excited because Nerina said that we're not just going to be talking ETFs or AMTFs or ETNs or ABC or all these other acronyms. We have no idea what they mean. Nerina, thanks so much for joining us. The markets are exciting as always. We really appreciate your insights and taking the time to share your brilliance with us. So over to you and welcome.
Thank you so much, Carl. Thank you for that very kind introduction. And yes, absolutely an honor and a pleasure to spend the time with you and the Easy community. We're certainly living in interesting times. We thought that probably one of the most common questions that I'm getting from clients is this unease that people feel about the state of the world and all of the chaos that seems to be going on around us and so on. And at the same time, we've got this disconnect where markets just appear to be continuously making new highs. And not only are people battling to sort of understand why this disconnect, but they're also saying, but how long can this keep going? What next? How should I be positioned in my investment portfolios for the next phase? And so I thought it might be worthwhile for us to just spend a little bit of time to try and unpack a little bit why this disconnect between what we hear so much of in the noisy news versus what we see when we look at our investment statements and we see the wonderful news of all the new all-time highs and strong performance that we've seen from markets. And then most importantly, certainly would want to look forward and say, it's easy to look back. It's very easy to have a historic perspective on things, but really where we are here and now today is what does this mean for me for the rest of today, for tomorrow, for next week, and for the future of my investment. So that's certainly what I'm going to be talking to the community. And as you said, I'll take us through a couple of slides that I've prepared, and then certainly we'll have the opportunity for discussion and answer some questions. So we're going to look back and we're going to look forward. That's really what today is all about for me. I just want to make sure you are seeing my slides. Are they sharing on your side?
Your slides, hear you perfectly, all great. Not your first
row. Great stuff. Right, so let's get straight into it because Carl, you and I did this exactly a year ago as well. So I thought let's maybe look back and see what did we say in August 2024? What was the state of affairs, not just so much in the market, but also in terms of the economy as we saw it? And we had highlighted a couple of things in terms of where we saw things at the time and what we expected the future for us to hold. And so looking back at that outlook of a year ago, certainly inflation has peaked, approaching central bank targets. Interest rates have peaked. We've seen the cut in interest rates globally, not just in those developed markets that we mentioned, but of course in South Africa as well. We said at the time that we would expect an economic slowdown rather than a recession, a so-called soft landing, and that's certainly also what has transpired. Another very important view that we had at the time was that we expected the US dollar to moderate from those very historically strong levels. And not only has the dollar certainly weakened quite substantially over the last 12 months, but with that, of course, we've also seen the strength in the rand. And so it does call into question a lot of our views in terms of where and how to invest. Despite all of these changes, we did not expect that there would be a significant impact, certainly not a negative impact on US corporate earnings, and we saw that. The impact has certainly been limited so far. The jury is out on what will come next, but we're going to talk about that. And then very much it was a case of risk on was back in play. Now, for that one, I give us sort of a maybe, because I had heard a lovely quote earlier this morning, says we all know about bull markets and we know about bear markets, but what we're experiencing is kangaroo markets. These things seem to be jumping up and down all over the place, and certainly President Trump is a big contributor to that kangaroo market environment that we've got. But we did also highlight elevated levels of geopolitical risk. And I think in my wildest dreams, I certainly did not expect it to be quite as wild as we've seen it, and no signs of it abating at this stage. We also highlighted the elevated US valuations, US equities in particular, and that certainly was a feature for us. What about South Africa? We had a similar sort of outlook in terms of where we saw the South African economy and the South African market. Here too, we had inflation peaked, approaching the central bank target. I guess that target is a bit of a moving target nowadays, but certainly coming down quite nicely. Interest rates had peaked. At the time, we expected the first cut. We have since then already seen 3 cuts in interest rates by the SARB. We spoke about the economic recovery in South Africa that we thought would be forthcoming. And here I must admit that the GNU, I think, has certainly not quite delivered, I think, what we thought could have been delivered at the time. There are some positive signs, but we definitely need more evidence. The load shedding alleviation has been a great boost, I think, both to business and consumer sentiment, and certainly assists in terms of corporate South Africa. But water seems to be the next big problem that we've got on the horizon. Operation Vulindlela, really interesting in terms of the infrastructure investment boost. We've certainly seen some good evidence come from that, and I think exactly that load shedding alleviation is one of the examples that we see of great public-private partnerships, and we're starting to see more of this materializing, especially in the transport sector, Transnet, as well as the ports and so on. But we need more evidence before it actually translates into real economic growth. We spoke about the commodity cycle, that is something that was very dependent on global and Chinese economic growth. But oh my goodness, let's not miss out on what's happened in terms of gold. And we're certainly going to talk about gold sitting yesterday breaching $3,700 for the first time. Can it go higher? And I'll reserve my judgment on that until we get to that. But then, as we also mentioned, Rand strength is a double-edged sword. Certainly from a domestic consumption, from an inflation outlook and so on, the strong Rand is great. But when it comes to our investments, because so many of our investments have got a strong global focus, either directly or indirectly, we really need to navigate this particular aspect of our investments very carefully. So I thought, let me summarize sort of where we are in terms of the macro picture in 4 slides for the US. Real GDP growth. So remember, we said that we expect a soft landing. We did not expect, a recession, certainly. And I must highlight those last 2 bars that you see there. The first quarter GDP number out of the US down 0.25%. This is quarter on quarter. The second quarter then up 3.3%. Now, in that particular case, this was very, very heavily influenced by preemptive imports in the first quarter in the US. And then so we saw a significant spike in imports ahead of the Liberation Day tariffs, so ahead of the 2nd of April. Now, imports is a drag or a negative impact on GDP, and that was primarily what caused that negative reading in the US GDP in the first quarter. Subsequent to that, we then in the second quarter saw a significant drop in imports. Now we had tariffs already come into play, and because you have lower imports, suddenly your GDP growth spikes. So I think we need to see where this sort of levels off. If you just take the average between those 2 quarters, 1.4, 1.5% growth, so somewhat lower maybe than what we've come accustomed to in the US, but we maintain that view that we think we are looking at a scenario of a soft landing, that growth will continue to power ahead. And we're going to talk about the impact of AI, and especially in terms of productivity gains and what that means. From an inflation perspective, when I look at that inflation graph, very benign, really, at around the 3% level. Now, I know the Fed target is officially 2%, but they seem to be reasonably comfortable with the current level of around about 3%. And we certainly have not seen any evidence yet either of actual inflation having transpired from the tariffs. But at the same time, even the outlook for where we are going in terms of that, there's a lot of good reason to think that inflation is actually pretty much under control in the US. Which leads us to that bottom left chart of the Fed funds rate, which you can see have been kept static for an extended period of time now, leading, of course, to a lot of frustration for President Trump, who desperately want to see that Fed fund rate a lot lower. Now, by this afternoon, we will know whether the expectation of 0.25% cuts by the Fed has transpired. So today's D-Day for that. And certainly, I think 25 basis points is pretty much baked in. If we get a much bigger, like a 50 basis point cut, I think that would give the market a bit of a skrik. But at the same time, I think what's a lot more important is their outlook. And I'm not going to go into the details of why there might be calls for bigger cuts. But if inflation remains under control, the Fed will find it very difficult to actually, especially with a relatively poorer outlook in terms of growth, the Fed will find it very difficult to justify maintaining interest rates at this relatively high level. The 10-year Treasury yield is really one of the key metrics, certainly, that Trumps look at, because this is typically the rate at which real estate deals, property transactions are priced at. And so he desperately wants to see that number closer to the 3% level. We're sitting around about the 4% level. Yes, it's moderated somewhat from the highs of around 5%, but he would love to see that a lot lower. And when we talk about the performance of bonds and also of listed property markets, you'll see why that very sticky level of around about 4% for the 10-year bond yield has been quite a drain on that particular part of the market. What about the South Africa picture? Well, our GDP growth, unfortunately, is not nearly as strong or as stable as the US growth picture. Most recent number that's come out, the second quarter growth number, certainly better. But as we said in our introductory slides, we need a lot more evidence. And certainly the South African economy and the South African consumer remains under pressure. If you look at our inflation rate, and I had done this graph before the release of today's inflation print, which came out at 3.3%. In South Africa as well, you see that our inflation rate is well anchored at around about the 3% level. Now, remember, officially, we are still in a 3 to 6% target range. And you can see from that perspective that despite that spike in inflation that we saw in 2022, South African inflation has really sort of been at the lower end of that 3 to 6% target. And with our own SAB unofficially targeting 3%, it might become official sometime soon. Certainly, our inflation rate not only is also stable and low, but the differential between our own inflation rate and that of the US has narrowed substantially. And when we talk about the dollar, and we talk about the rand dollar in particular, that is one of the reasons why we've seen relatively much lower sort of volatility in terms of the rand dollar exchange rate. Repo rates on our side, we've already seen 3 interest rate cuts in South Africa. So I guess one could say from a South African perspective, the Fed is behind the curve this time round. It is unlikely that we will see a further cut by the SAB this week. However, the fact that the inflation rate surprised to the downside today certainly gives fuel to the idea that with relatively high real interest rates that we have in South Africa, which certainly constrains growth also, there is scope for the Reserve Bank to lower interest rates further. I believe they will caution on the side of, or err on the side of caution, not cut rates just yet. But we've already seen 3 interest rate cuts, so that's quite nice. In our 10-year bond yield, you see much bigger movement that we've seen in our own bond yields, and the 10-year yield now well below the 9.5% level. And of course, that when you see that drop off in the bond yield rate, that translates into capital gains that you get in your bonds. So when we think of bonds and fixed interest investments and so on, we get a very good high interest rate Think of our coupon rates that are sitting somewhere between 8 and 9%, which is a guaranteed interest yield that you get. And then on top of that, you still get the capital appreciation as well, which is one of the reasons why South African government bonds have actually been one of the best investments that we've had in South Africa in recent times, despite the fact that we feel like, everything just seems to go into some dark, deep hole, corrupt hole in South Africa. Certainly the markets show you that there's a lot of reason for optimism in South Africa. How is this all translated into what we believe are four of the most important sort of themes and things that we want to watch in terms of investment markets? The first chart that I show you top left is US corporate profits. Now, please note that the numbers that you see, when you see 3.2, that's $3.2 trillion in a quarter. That's about the size of the South African GDP. So US companies are still making a lot of money. And despite all the noise and all the fears and the concerns and the supposed expectations around the impact of tariffs, this is not being felt in US corporate profits. And a very interesting aspect around that is to see the big boost that the AI spend is giving to productivity growth. And productivity growth translates directly into strong corporate profits for the US. So can the US market continue to power ahead as it has? Well, we think that there's a better than even chance that from an earnings perspective, they will continue to perform well and to perform strongly. The other side of it is the interest rate environment, and that is that when you have a declining interest rate environment, that powers or sustains your PE ratio. So even though US markets are overvalued or very highly valued by historical terms, there's a lot of good macro fundamentals that argue in favor of that and say, there's more to come. We're not going to see the end of it just yet. I heard a beautiful quote at a conference last week that said, bull markets don't die of old age. Bull markets get slaughtered by the Fed. Now, what does that mean? That means that it's only when interest rates start rising again in the US, something which we don't expect for a number of years, that is only the time where bull markets will come to an end. So with the Fed expected to cut interest rates today and to cut at least 2 more times, maybe even 3 after this, that means strong tailwinds for US markets. We're going to come back to that because, yes, that has been a dominant feature of investment markets for many, many years, but we do believe US corporate profits are sound and will sustain us for a while. The second graph, the one on the dollar index, is a really, really key one because I want to just point you to, sort of the decline in the dollar just in 2025 to date. You see that we started the year when Trump was inaugurated at around 110 was the level on the dollar index, and currently sitting well below 100. That means really that we've seen 10-15% weakening in the US dollar. Now, that is a significant factor in the global reserve currency. And of course, this translates directly into strength for all other currencies. That is developed market currencies such as the yen and the pound and the euro and the Swiss franc and so on, but certainly also for emerging market currencies. And the South African rand has been one of the best emerging market currencies, further boosted by the commodity cycle as well. But we'll come back to that as well. Now, you might look at that graph on the dollar index and say, okay, so is this it? Is this now the end of it? And I must emphasize that we don't believe that this is the end of it, that the dollar is on a long-term structural depreciating trend. It's not going to happen overnight. It's not suddenly going to become this weak currency. But what we do find is that it is on a weakening bias, and that therefore we need to think very carefully in terms of our investment strategies when it comes to how we deal with our rand dollar exposure in our portfolios. The bottom left chart is a very long-term chart of emerging markets relative to developed markets. Just as a reminder, the MSCI World Index is just developed markets. So when you see an increase in that graph, like we saw in the beginning of it, that is a period when emerging markets outperform developed markets. When the graph slopes down, developed markets are outperforming. And so you can see that for the last 15 years, it has been an extended cycle. For the last 15 years, developed markets have significantly outperformed emerging markets. And so we see and understand why this US exceptionalism and the strong performance of the US markets and so on over the last 15 years has made that sort of the one-trick pony in your books. You know, as long as you were invested in the S&P 500 and preferably in the Mag 7 or the AI stocks, you were doing absolutely fine. The question is, what about where we are moving into? And when you combine the outlook for the dollar index, amongst other things, but also the positioning, the shift of the world from a unipolar or perhaps a slight bipolar world, but a unipolar world from US exceptionalism and dominance to a multipolar world, largely caused by and driven by Trump's trade policies and the way that he's just dishing it out like Oprah does. You know, here's one for you, and here's one for you, and here's one for you. Everybody gets a tariff. He's pushing us into a multipolar world, which certainly bodes much stronger for emerging markets. And so you're going to see that's one of our key themes that we really focus on for future investments, is to focus much more strongly on emerging markets. And then the final graph on this one is the gold price. And I think, were probably hiding under a rock for the last year if you have not heard the fact that the gold price has made all-time highs. It seems to be happening with almost daily regularity. And this particular graph that I'm showing you here has actually been adjusted for inflation. So if you take inflation into consideration as well, the gold price is at an even higher level. So many people then say, well, so is this it? Is this as high as it's going to go? And again, I want to emphasize here that no, we believe the gold price has more room to go. And it's a part of a much bigger picture in terms of the shift of the world from having all of their reserves and all of their assets in dollar-denominated assets, either the currency itself or in US treasuries and so on, and about central banks and even companies diversifying their assets, diversifying their reserves, and moving a lot more into what we would refer to as real assets, specifically the precious metal gold. So this sets the scene for some of what we're going to be talking about in a bit. Let's just quickly look back then at the asset class performance over the last 12 months. Now, I want to first point you to the scale on the left-hand side. Yes, that is a 40% return that you've seen in the last 12 months for gold. But the first 4 bars on that chart, that's all South African assets, South African equities, South African property, South African bonds, South African cash even, that gave you very nice results. That black bar in the middle, that's Rand strength. The fact that it's a negative number means that the Rand appreciated against the dollar. Global equities, despite that Rand strength, this is all in Rand terms, what I'm showing you here, global equities still gave very good results, but you can see that South African equities significantly outperformed global equities over the past 12 months. Bonds, property, remember what I said about that 10-year bond yield and the extent to which that's been a drag on the performance of both property and bonds globally, in negative territory, and then gold being the significant one. But I must hasten to add that this has been a very exceptional 12-month period. If you look back a little bit longer, over the last 10 years, same axis, same scale of 40%, you see exactly how exceptional the performance has been in the context of a longer dated history. And so when we look at building resilient portfolios for a future outlook, we need to keep the more realistic, longer-term perspective in mind rather than this exceptional period that we've just come out of. So when we build resilient portfolios, really, I mean, we can talk about things like the property and this and that and so on, and even gold. And it's definitely interesting, and it definitely adds some interesting flavor to a portfolio. But when we build resilient portfolios, multi-asset, balanced fund portfolios, we focus mostly on 3 primary asset classes, being South African equities, South African bonds, and global equities. And when we then want to build these major, these balanced fund portfolios, our aim really here is to beat inflation over the longer term. That's how you grow wealth, is by getting investment performance that outperforms inflation. And if we now look sort of over the last 10 years on average, South African inflation has averaged just under 5% per annum. So look at this graph and you can see how SA equities, SA bonds, and global equities have comfortably outperformed that 5% level. And that's why that's our primary focus in terms of building balanced portfolios when we do this. More recently, I mean, it's over the last 12 months, we've completely outperformed this because our average inflation in South Africa over the last 12 months has only been 3.1%. So we are absolutely creating wealth in real terms at the moment by focusing on these investments. But this is where the idea of maybe some kangaroo markets come in. So what I'm showing you here is over the long term, we can see great. We see that lovely performance from those three major asset classes. But when I show you the performance of these three asset classes on a discrete 12-month rolling basis, so this is all up to the end of August every year. Only reason why I chose August is because we're doing this in September, and therefore the most recent period, 12-month period, ended in August. What I'm showing you is what was the top performing of these three major asset classes. What was the top performing? What was the worst performing in any rolling 12-month period? And now you see, but this is all over the place. Okay, great. So in 2016, global equities gave us 16.7%, best performer. The very next year, worst performer, 6.2%. The year thereafter, 26.4%, top performer. And so it goes on. And it's not just up and down every year. You get a 3-year period from 2018 to 2020 where South African equities was the worst performer. Then it gets followed by 2 years where it's the best performer. This thing is all over the place. It becomes very, very difficult, therefore, to focus on individual asset classes and to sustainably build wealth in just a single asset class. When we look at these, by the way, why some of them are red, those are what we would classify growth assets. Now, as I said, mostly SA equities, global equities, and you would add listed property into that as well. The green asset classes would be your income generating assets, interest bearing typically. So SA bonds being the primary one, but you would also put SA bonds and global bonds, global cash and so on in there as well. But then you might ask me, okay, so what are those gray blocks that you've got there that very nice and stably sort of operates in the middle? It's never the top performer, but it's certainly also never the bottom performer. And that's where the strength of a balanced portfolio, a multi-asset high equity portfolio comes into play. And so a year ago, when we had this conversation, was at the time where we launched the first actively managed ETF, balanced fund, actively managed ETF on the JSE. And we were really looking here at something that can become the foundation of a well-diversified investment portfolio, because we want to focus on long-term wealth creation. And so we focused on a static balance of 70% in growth assets, 30% in income assets. And you see sort of the makeup there. So yes, in addition to SA and global equities and SA bonds, we do have a bit of SA property and some SA cash in there as well. Now, very importantly, even though this is an actively managed ETF, the underlying investments are certainly not actively managed. Point number one, we use a strategic asset allocation, means it doesn't change over time. You always have the same asset allocation, irrespective of market conditions. Furthermore, each of these major asset classes, we invest only in the broad market index. So in the case of SA equities, it would be the JSE Capped SWIX index. In the case of SA bonds, it's the All Bond index. In the case of global equities, it is the MSCI All Country World Index. So we don't actively manage the asset allocation. We don't actively manage the exposures inside each of the asset classes. And that really then gives you this single investment that is a great core foundation building block to a portfolio. And we've now just celebrated our first birthday, and you can see there on the left-hand side, since inception, around about 17.6%. Over that same period, the CISA category average, which is the multi-asset high equity category, 15.1%. So comfortably outperformed its peer group in terms of that. Assets under management, 655 million rand, total expense ratio, which incorporates all of the costs also of the underlying investments that we've got in this, 0.52%, over 1,750 investors. And that's sort of our basic core building block that we wanted to look at. So what about looking forward? Where do we go now? And so I want to go back and sort of reiterate a strategy that we presented last year, which is exactly this core and explore idea. The idea is that in your core, you have this balanced foundation, multi-asset portfolio. And as I said, that's 30% SA equities, 35% foreign equities, 30% SA interest bearing. So you see what that makeup looks like. And then we suggested to you a year ago, this is just your starting point. This is your core that you start with. From this perspective, you can dial down risk. You could be a more risk-averse investor, or you could be someone who needs more regular income from your portfolio. And there are 4 different strategies in which one can dial down risk of this multi-asset high equity portfolio. But by that same token, you can dial up risk. You can, through different strategies, also add risk to a portfolio, add very specific exposures to a portfolio over and above what you know is in your core. And so today I'm going to talk to you about sort of 4 themes, 4 ideas that we have for the future, for the next year in terms of our investments. And the very first one I want to start with is to say, you might look at this and say, okay, 35% global equities, that seems a bit on the light side. You know, South Africa is less than 0.5% of the world's GDP. It's only 1% of the world's global stock markets. No, man, we need a lot more global equities in our portfolio. So I say, okay, that's fine. But we know that that global equity exposure is absolutely dominated by the US. In the first place, developed markets represent 90% of the all-country world index, and the US represents 75% of that world index. So if I'm going to add global equities, I'm not going to do it in the US. That's this strategy. This strategy says, let's look at the developed markets outside of the US. And those would specifically be Europe, Japan, and UK. And in fact, we've got 3 ETFs for each of those 3 regions listed on the JSE, Signia ETFs that have been around for an extended period of time. And I've given you an indication there of the proportions, 50% in the EU, 35% in Japan, 15% in UK. And you will pretty much replicate what developed markets outside of the US look like. And why do we want to do that? Well, there's your relative valuation picture. The US sitting at just under 28 times PE. Developed markets, excluding the US or outside of the US, at 10 times low, 17.4. So for me, that would be a very strong argument to say, sticking with my developed markets, but I'm going to diversify. And an important reason for me for this diversification is not just about the US. It is also about the US dollar. Because each of those 3 building blocks, Europe, Japan, and UK, even though you might invest in it in rands, and some of them might still be dollar denominated in terms of the underlying ETFs, the drivers of the performance of those 3 markets are in part also driven by the relative currency performance. So the euro, the yen, the pound relative to the US dollar. And for me, that's an important diversification to bring into a portfolio in the context of a weakening dollar that we see. If you have a hard currency portfolio, so if you're managing your investments through a global investment platform where you've got access to it, our preferred one, or certainly one that one can look at there, is the iShares MSCA EAFE ETF. Now that EAFE stands for Europe, Far East, and Australasia and Far East. Sorry, Australasia being Australia and New Zealand. So there is a single ETF available in global markets. Unfortunately, our South African ETF providers have been asleep at the wheel. Maybe one of them will catch my hint and bring us a DMX US and EAFE ETF to the JSE. So you might look at this and you say, no, but wait a minute, Nerina, you showed us that graph that showed that developed markets have reached a bottom point in terms of their performance relative to emerging markets. It's time for emerging markets to shine. So I rather want to add to emerging market exposure, because if DMs, developed markets, are 90% of the ACWI, then EMs are only 10%. And yet they represent more than half of the world's population. They represent a substantial part of the world economy, of the GDP. How can I only have 10% of my investment portfolio in emerging markets? And so adding emerging markets specifically, and we quite favor Asian emerging markets, which, by the way, happens to still be 80% of emerging markets. So we have a couple of options available on the JSE. You could go for emerging markets in general, but that would give you the full spectrum. I'm just listing 3 there for you that only focus on emerging markets, and specifically between that One Invest and the Signia product, I've tried to give you an idea also of the country breakdown in those. The most interesting or stark sort of difference being that the Signia EM50, which is just the top 50 emerging markets, only has a 7% exposure to India, whereas in the One Invest MSCI emerging market Asia, India has a 20% exposure. Now, remember, we do also have a India-specific ETF on the JSE, so you could also supplement, add more India into your portfolio if you want to. Probably the preferred area for us at this stage is actually China directly, and we've got those 2 options. That's going to give you 100% of China. We don't have nearly enough time to go into the investment case for China today, but I wanted to present you with some options in terms of how you can specifically add on emerging market exposure to your portfolio by using these ETFs. From a hard currency perspective, we could look at the iShares MSCI EM Asia. By the way, exactly the ETF that the One Invest invest in, that One Invest ETF, is a feeder fund. So all that it does is it buys exactly that iShares ETF for you, but they take care of all the offshore trading, the currency conversion, everything else that goes with it. So the iShares MSCI EM Asia, or you could go for one of the iShares MSCI China indices if you want to have just China exposure. Now, some of you might look at this and say, I don't buy this other markets. I don't want to get into the rest of DMs. I don't like emerging markets or China. I want to stick to my developed markets in the US. And in fact, I'm loving this AI story. This is where my money's going to go, and I want to invest in it. And trust me, there are many, many good reasons why I agree with you in terms of the investment case for AI. But please, I'm pleading with you today, please look beyond the MAG 7 stocks. Those 7 companies is 25% of the world's global stock markets. Doesn't matter what type of global equity portfolio you have, you already have a lot of MAG 7. In fact, when you look at the S&P 500, 35% of it is MAG 7. In the NASDAQ, if you buy the NASDAQ, you own basically 2/3 of that NASDAQ is just the MAG 7 company. So really, you have a lot of it already. Please don't go and add more NVIDIA, Apple, Meta, whatever you want to call it, to your already heavily exposed portfolios to MAG 7. And what's wonderful about this is that we've on the JSE got these other options available. So I wanted to just mention for you, for example, some of the UBS index tracking notes that we've got available. And I've just sort of mentioned the indices for you there that they track. You can certainly go and do your research, but I want to tell you that there's a big world in AI beyond the MAG 7. Robotics and drones, FinTech 20, big data, the metaverse. By the way, that UBRAIC, the S&P Kensho New Economy, some of you might remember that from the early Signia Fourth Industrial Revolution days. That ETF used to track exactly that index. It no longer does. But that one is available for you in a note by UBS. So some really interesting options that you can still be invested in AI, still be invested in this mega tech theme, but in a more differentiated way. There are also actively managed ETFs that specifically focus on the AI theme. Easy AI, you had it all in the name. And what does the Easy AI ETF, the actively managed ETF, use as its reference index? It's actively managed, so it doesn't track that index, but you can see that's also robotics and AI. The Signia 4IR, as I say, it now tracks the Solvactive GBS US 500. So it's more like an S&P 500 as its universe, no longer that Kensho New Economy. And then the SciFang, the Signia Fang AI one that uses as its starting universe the New York Stock Exchange Fang Plus Index. But, and here's a big warning for these actively managed products. Because they are actively managed, it's hugely important that you monitor what the underlying exposures are, especially if you are using them alongside something else in your portfolio. I termed the phrase diversification many years ago, where people think that they diversify, they're using different investments, but actually they are just concentrating, they're doing the same thing over and over again, and I call that diversification. And I hate to name and shame, so I'm not going to do it. All I'm going to say to you is please watch the costs also, because some, not all, but some of these actively managed ETFs have got excessively high costs for what you are getting. So make sure that you make smart choices, both in terms of what the underlying investments are, but also what you're paying for those investments. Globally, if you've got a hard currency portfolio, two of the ones that we really like, Global X has got two different types of AI exposure. The first one, the artificial intelligence and technology, is more of your traditional sort of exposures to AI. The artificial intelligence and infrastructure one, the AINF, is one that I really love, because this invests in all the companies that actually have to contribute to building out the infrastructure that is needed for AI. And so there's some really interesting alternative ways in which one can get truly diversified exposure to this mega tech AI theme that we've got. Final one, you might say to me, ish, no, this is way too much equity. I don't know. Things are at an all-time high. Things are very expensive. I feel nervous. Don't know what Trump's going to do next. Bring me some real assets in my portfolio. And the obvious one for all of us when we look at this, certainly coming from a South African perspective also, is gold, physical gold. So not gold mining companies, even though they've been spectacular performers and they do have a place in a portfolio. I'm talking gold bullion. Gold price, as I say, at record highs. Can it still go higher? Absolutely, we believe it can. You could also look at some of the other precious metal ETFs, between ETFSA and Standard Bank under the One Invest brand, have got a range of the precious metal ETFs that one can consider. So certainly has a role to play. But for me, the pure exposure really sits in your gold bullion. And for me, a very, very important component, a bolt-on component sort of a well-diversified portfolio. Internationally or hard currency options, certainly iShares physical gold, much like the ETFSA New Gold or the One Invest Gold. And to preempt questions which I know are probably going to come up, yes, cryptocurrency ETFs. And we do nowadays have in our global portfolios the ability to invest in a Bitcoin ETF, in an Ethereum ETF, and many more to come. And watch the space. We don't know when, but it's going to come to a South African market close to you sometime soon. Of course, fortunately, we do already have ways in which we can bolt on or add on crypto exposure to our portfolios where appropriate and when we understand it well enough and we have the appetite for it. But Carl, as always, I've overstayed my welcome. I've spoken way too much and way too long. So I'm now going to zip it and hand over to you for some questions.
Thanks very much, Nerina. And I would interrupt you if you were speaking long and a lot of rubbish, but it is fabulously interesting. So thank you very much. I'm going to ask you, you're perfect. Yeah, super interesting, Nerina. I love listening to you. And I was reminded while you were talking and also some of the questions coming in, worthwhile mentioning to the hundreds of people that have joined us that investing, there isn't a perfect answer, and it's not a get quick rich scheme. I always say you need to go rob a bank or gamble if you want to win lots of money, and you'll probably lose it as quickly, and it's not legal. But what I love about your style always, a good investor, it is about doing the homework. It is about doing your own research and using the many tools. And then it's consistency. It's not in or out. I think it was really useful to look back, the 12 months. What did we get right? What did we get wrong? And some pointers going forward. But I do want to jump straight into it. And I'm going to pick up on the Bitcoin. When you were speaking about asset classes, you didn't have crypto in there.
Yeah.
Why is that? I mean, do you think it's not resilient? It's too volatile? I mean, just as an asset class, crypto, where's your mind at?
Yeah, so it absolutely is an asset class. I restricted myself to more traditional asset classes that are currently readily available to investors, especially DIY investors. So you would also see I didn't have things like private equity in there. I didn't have other alternatives. I didn't have hedge funds in there. There are many other investment options that could be feasibly classed as asset classes that I didn't put in there. Is cryptocurrency or crypto assets a separate asset class? Yes, I do believe so. Interesting that certainly from the US perspective, there's still an ongoing fight between whether this is it's a security or whether it's a currency or whether it's a commodity or how to even almost label this. And I think it talks to exactly the unique nature of crypto assets. And I want to emphasize that there is so much more to crypto assets than Bitcoin. And when you also look at the rise of the use of tokenization of assets, that also talks to a different access mechanism to a very broad range of different types of investments. In fact, I would argue that ETFs were almost your first form of tokenized assets. I'm stretching it a little bit there, but I think you get where I'm coming from. And we are seeing strong growth in tokenization of assets that then enables investors to get access to investment assets that are not readily available, such as private equity, private debt, for example, physical investment properties, real estate, a whole range of alternatives. So let's differentiate also between crypto as an asset class and crypto as an investment access point for investors to bring many different types of investments into their portfolios.
Just when I'm listening to you again, Nerina, I'm reminded at Easy Equities, we've got a Carly clone, and that really helps us in a lot of our writing because Carly's so brilliant. We've got to get an Nerina clone. So if your colleagues at ETFSA haven't done that yet, we need an Nerina clone. But talking about Carly, because it was one of the things that I know she loved a year ago, that concept of core and explore. And so I want to go back to a little bit of what you were talking about there, and you were mentioning the emerging markets. And
yes.
am I right in understanding you said a large part of that is Asia? I mean, it was a crazy stat. Was it 70, 80%?
80%.
Yeah.
80%, yeah, is Asia.
Now, in my limited understanding, I always think emerging markets, it's little South Africa and others. I mean, is it fair to call those massive markets emerging markets? Is an emerging market anything that's not US? I mean, why do we not talk about Brazil and all of these other places?
So Carl, you are preaching to the converted, and you certainly shouldn't be asking me that question. That's a question for the likes of MSCI or S&P Dow Jones in terms of their classifications. But I think what it does talk to is it's more about a classification of the development and the sophistication and the access of the financial markets rather than the size of the economies and what goes with it. So yes, of course, South Africa is part of that emerging market universe, but it's a relatively small part. It's only about 3%. So that's another question that I often get, that people say, oh, but I already have South Africa. I don't need other emerging markets. Well, you're missing out on the other 97% of emerging markets. And I think what's really useful in terms of looking at those, and EM Asia has been our preferred space for quite a while. But for me, the very interesting next wave in terms of this is Latin America. Latin America, you mentioned Brazil, but if you think also, especially if we are expecting a longer term commodity sort of cycle again, Latin America is a great place to be. Of course, the other major sort of aspect of emerging markets is Eastern Europe. Now, I think Eastern Europe has come under a lot of pressure because of Russia, Ukraine, a lot of the conflict that's going on in there, and through South African companies. Interestingly enough, I don't think South African managers are afraid of emerging markets. So many, especially when you look at real estate, for example, our listed property sector has got some big exposure to Eastern European property and so on. So from the perspective of what makes up emerging markets, you cannot ignore the size and the influence of China, India, South Korea, Taiwan, those being the four obvious ones in terms of this. And in this shift to a multipolar world where we are now seeing increasing bilateral arrangements between different countries. So you're going to see that China and Brazil does transactions and trade either in the renminbi or in the real. And you're going to find that between Russia and India, well, it's going to be either rubles or rupees, you know. So you're finding this disbursement almost of currency in which transactions are being undertaken and so on. And so for me, not exposing yourself to that opportunity set, I think means missing out on a lot of potential opportunity as far as that is concerned.
Fabulous. So we're a year into your wonderful actively managed ETF, and I say wonderful because I'm an investor and it certainly has served me well, and congratulations. I mean, you showed us some of the stats there, and it's just the beginning. And I want to tag on that to one of the questions from somebody in the industry who asks, has the shift or the adoption of actively managed ETFs by traditional fund managers been slower than what one would have expected? Or do we still see that this boom of actively managed ETF is long-term and that it really is the future? I mean, some people say unit trusts won't exist. It's going to be all actively managed ETFs. Yeah, what is your view on that? Do you think the take-up has been slow?
Yes, yes, it absolutely has been slow for many reasons, and we're certainly not going to go into all of those reasons now. But when we talk about ETF, and here it doesn't matter whether we're talking index tracking or actively managed, and we talk about the unlisted version being unit trusts. As far as I'm concerned, the exchange traded version is really just the 21st century version of unit trusts. It's still the same CIS structure underneath all of this. So what is the benefit that listing this product brings to the equation? So I think the major benefits for me that it brings to the equation is cost savings. Now, people tend to think that when we talk about low cost in ETFs, it's because there's not some expensive asset manager that needs to be paid a portion, a yacht every year. That's not what I'm talking about. When you look at the management of investments, a unit trust, every time, an unlisted unit trust, every time there is a buy and a sell transaction, the unit trust manager has to go into the underlying market and trade twice, buying assets, selling assets in order to effect those buy and sells at the unit trust level, because they're not allowed to exchange existing units of the unit trust between buyers and sellers. When you list those exact same units on the exchange, there it is, it's in the word, it's the exchange. The exchange gives the ability to exchange existing units between buyers and sellers. Therefore, you don't have to go into the underlying market and incur double transaction costs, which, by the way, is not an apparent cost that you see in the TER of that unit trust. It sits in the net asset value. It actually erodes the net, and that net asset value is affected for all the existing investors in that unit trust. So for me, listing it on the exchange is just a much more efficient way of managing investments. Why has it been slow? And as I say, there are many reasons, but you do need to appreciate that the majority of asset flow in South Africa still takes place via LISP platforms. And LISP platforms have been very slow to adopt access to exchange traded, exchange listed instruments, whether those are individual shares or whether they are ETFs, be it index tracking or actively managed. They've just been very slow to provide access to it. What I find fascinating is we've seen strong interest in actively managed ETFs from some of our big active asset managers, I think, who've actually understood this thing about the benefit that it brings for them as the unit trust company. Because what is the big benefit for them? Two things. They get a whole new distribution channel. They've got access now to people that invest via the stock market rather than via list platforms. So it's a whole new universe of potential investors for them. But the second thing is the unit trust manco is responsible for the client administration. They've got to keep record of who owns how many units of what of our unit trusts or whatever. That's a big expense for the unit trust manco. You list it on the exchange, straight does it for you. You as the manco don't need to have that expense. So once they start appreciating the benefit even for them as a manco, I think we'll see a lot more of it. Certainly, the two major sort of areas of actively managed ETFs that we've seen is in the fixed income or the enhanced income, the interest-bearing space. That's been hugely successful. And then we've seen a couple of the balanced fund ETFs that have come to market, which, by the way, 50% of all assets in South Africa are actually invested in balanced funds, in multi-asset funds. So as far as I'm concerned, that's the low-hanging fruit. That's the obvious place where we should see a lot more of this happening. There has been a bit of a bottleneck at the SARB in terms of the globally referenced actively managed ETFs, but I believe that is now being resolved or about to be resolved. So I always want to say, watch this space. I think we are going to see the floodgates now being opened and a lot more actively managed ETFs come to the JSE. And I say, great. But for investors, now you need to do more work and different work. So that's really important. I've always said there is no such thing as passive investments. There's only active investments, but it's about what decisions do you make actively and what do you need to analyze, investigate, look at, and so on in order to make active decisions.
Absolutely. Well put. And we couldn't agree with you more, Nerina, from an easy equities perspective. And it's the second largest active ETF manco on the JSE. We're a firm supporter of this, and we also think the floodgates are going to open. We've only got a couple of minutes left, and so I just want to make a few comments. We are going to be sharing this webinar recording with everybody who registered. So those of you attending now will get it. It will also be on the Easy Equities YouTube channel. There are a couple of great questions that we haven't gotten to. Some are specific to some ETFSA products, and some are specific to Easy Equities, the platform and products. We'll make sure that those are answered by Nerina and her team, and also from us on the Easy Equities side. But there's some generic, I'll call it generic, really good questions. And Nerina will share those, and in sending out the webinar, we'll attach a little bit of an answer from you and maybe one or two others in the community, because they really are useful and will help everybody. Because I don't want to go beyond our 2 o'clock hard deadline. I'm going to conclude by asking you a couple of softball questions. So, gold we spoke about, and the fabulous gold bar. Do you think that South Africa has taken enough advantage of this boom in gold? And if not, why not?
Well, I'm going to answer it from two perspectives. Has the South African gold mining industry taken enough advantage? They've taken as much advantage as they can. South African gold reserves and deposits are exceptionally deep underground, very expensive to get to, very difficult to get to. So I don't think there's much more that could have been done. Have South African investors taken enough opportunity from gold? An emphatic no. An emphatic no. And it's interesting when you go back to the unit trust sort of question, the only way that a unit trust can invest in physical gold is with a gold ETF, because they can't hold bullion. Our exchange control regulations, in fact, also that's why only ETFSA and Standard Bank has got these precious metal ETFs, because they're the only two banks that actually have the license that allows them to hold the physical gold. So for any investor, whether you're a large institutional investor, a unit trust company, or a pension fund or whatever, the only way that you can invest in gold is through the gold ETF. Now, the ETFSA New Gold ETF is the largest ETF on the JSE, but it is minuscule compared to the potential opportunity set. So I think my answer is no, we haven't.
Thank you. Rina, last question and a serious question. You are so articulate and so smart, and I'm not just saying that. I mean, we've got many comments, and you've got a massive track record over decades in this market. You're always so eloquent. You're always so available to people. How do you do it? So you might not always realize, I think, what a role model you are to people, and not just women in the industry, but everybody in the industry. How do you keep this balance? To do your research, to be so smart, to be so energetic, to be so positive. What is the non-ETF resilient comment you can give us? Because I think you are inspirational for so many people, and we can take many lessons from you.
Thank you, Carl. I really do appreciate that. You know what? For me, it really does come down to two key things. I am actually really interested in all of this stuff. I do also have an amazing husband. I must add that. And I often say to him, he is the wind beneath my wings, that very cheesy quote from the song. But he allows me the space to sit there on the flipping business channels at night and actually listen to the stuff and watch the stuff and so on. So I'm really interested in it. But I think for me, probably a big part of the passion comes from another term that I coined, which is I'm mad. I'm mad in the sense that I like to make a difference. And if I can go to bed at night feeling that I've made a difference in the world, in the life of individuals that came across my path, in our industry, in the way that the fabulous wealth that we actually have available on this planet can better serve all the people on this planet, then I go to bed and sleep well because I feel that I've been mad and it's paid off.
Thanks, Nerina. That's wonderful. And a huge congratulations to you and the rest of the team at ETFSA on what you have achieved and what you're continuing to achieve. Thank you for sharing your products and your insights with the Easy Equities community. We are massive fans with what you and the ETFSA are doing. And as I said, we'll get this recording out with a couple more answers. Yeah, we'll do this annually. We'll have to do it annually now that we've started the
Absolutely.
tradition.
Absolutely.
I'm
We've now
using you
set
as
the
free
standard.
investment advice. I was making notes of what I need to go check out now and my own research. So
Yeah.
between the kangaroos and Trumpology and everything else, got some good
Yeah,
tips. So
no,
thank you very much.
thank you very much, Carl. And certainly it's a relationship that we also treasure. We know that for both Easy and ETFSA, at the root of all of this is really about empowering people with the knowledge and understanding to be able to take control of their financial destiny. And so it's a partnership that we treasure, and I look forward to many more opportunities such as this to spread the love.
For sure. And we've got to drip some of those tidbits of data and nuggets from both our respective entities, Nerina, because I love that, there's over R1 billion of new cash that comes onto Easy Equities every month now by these investors that 10, 11 years ago, many people wrote off. The success that you guys are achieving. Retail investors are smart. They're engaged.
Yeah,
And they're just growing in numbers. So,
yeah,
yeah, look
love
forward to
it.
next year. And thank you so much. Have a good rest of the day.
Indeed.
Thanks
Thanks,
everybody for joining.
everybody.
Bye bye.
Bye.